Hey everyone, me Kevin here. 8 days ago, I broke down an op-ed from Robert Shiller about what was going on in the market, that investor fear was at all-time highs, and not only that, but valuations were at all-time highs. And this mix was not good and would probably signal cause for concern and cause for volatility. Well, today, Robert Shiller was interviewed on CNBC, and the first question he gets asked is, hey, can people talk themselves into a recession? Or what's going to happen in the short term and what's going to happen in the long term? So let's go ahead and buckle up and listen to what he says. I notice I'm kind of in the way of his face here, so I'm gonna move that. While I move that, I do want to remind you to get 2 free stocks with Webull. I'm sorry, 3 free stocks with Webull. Look, it gets even better. 3 free stocks with Webull via the link down below when you deposit $100, and of course get life insurance in as little as 5 minutes. Okay, here we go.
Very high that people can talk themselves into a market crash? I mean, what's the implication for people having a market narrative in their head that the market could crash? Because the market did have a pretty big drop, 30%, just a little while ago, and we sort of went through that, and the markets are back with tremendous stimulus. Is there something that's concerning you now with this narrative that people have in their heads that somehow they could wish it to happen?
Yeah, that what happened between February 19th and March 23rd was the embellishment of a pandemic narrative, and the word depression, talk about the Great Depression. Now they sound like very different things, but for a while at least we thought they were similar, and so maybe that's past.
That's huge right there. So he says at the beginning of this pandemic, between February 19th and March 23rd, the bottom of the market, the market incorporated, or his words, exhibited the embellishment of the pandemic narrative and associated that with depression, aka pandemic equals depression. Oh crap, everything hits the fan, this is bad. He suggests that that fear level is actually gone, that we don't have those peak fears of depression right now anymore. By the way, keep this in mind as well. When that pandemic fear was at like max depression point, what did companies do? They cut advertising, they cut spending. What are companies doing now? Even though we're coming upon the second wave, they're spending more on ads. Clorox just increased their advertising spending by 30%. And a lot of companies are doing exactly this. We are going into a second wave, so it does somewhat make sense that Clorox would increase some of their advertising, but it also goes to show that companies are much more confident and they're in less of a need of a cash situation or cash-rich situation for another dip. Interesting, another thing to keep an eye on. Let's see what else he says.
I'm not counseling pulling out of the market. I'm not being alarmist here.
Okay, I mean, this is reasonable too. He says, don't pull out of the market. Okay, I mean, but let's see what else he says. We want his insights.
But I'm thinking that there might be some rough riding in the long run.
Some lag here on their end.
The most expensive market in the world, but it does still have a excess return compared with alternatives.
Okay, so what he said here was that the stock market right now, even though it's highly valued and even though we have high volatility and high fear right now, it still suggests, like his data still suggests, that the stock market will outperform other assets such as bonds in the long run, especially with how low interest rates are right now. However, buckle up, we're gonna be on a ride in the short term. Let's see what else he says.
The issues that I have, though, is relative valuations. You talked about high bond prices a few years ago, and I think it was the 3rd edition of Irrational Exuberance. And prices are remaining high for bonds, and yields have been remaining low, and it looks like they're going to remain low for years. So is it not unreasonable to suggest that the stock market, given the demand for stocks, is reasonably valued compared to bonds at this point?
Just an explanation. What he's asking is, look, bonds are expensive right now because the yields on them are very low. Interest rates are very, very low. Does that potentially say that maybe the stock market is reasonably valued?
Well, I don't know what reasonably valued means, but yeah, I'm advocating investing in stocks. So I'm not. This is not a doomsday scenario for me. But I think that it's interesting to note that it is a time of exceptional uncertainty as I've measured it.
This is interesting. It's not a doomsday scenario, but we also don't really know what scenario we're in, which is very different from February, which that was a doomsday scenario where the only outcome was down. Jeez.
And I don't have the ability to say what that necessarily means. It could be a contrarian indicator, and it could mean that it's a good time to invest.
That's the irony, by the way, of a contrarian indicator, is sometimes you see these charts that say, like, for example, I keep seeing these things, like especially on the doom and gloomer channels. You'll see people put up, look at the Shiller PE ratio or the CAPE index. Like, oh, they take these charts and go, oh, look, relatively, they're so high compared to where they were. And I've broken down a reaction to all of these. You can look at my stock playlist and see some of the other videos where I go through specifically these charts and kind of debunk them. But a contrarian indicator is something where ordinarily you look at the chart and you see it's really high, and in the past it's been high before a crash, and it's like, well, history's going to repeat itself. Robert Shiller here is saying we don't actually really know that. We can't rule that possibility out, but we don't know that in this pandemic scenario that we're in, especially with these crazy shifting trends that we're experiencing.
I think you have to, the market is very complicated, and it depends on the interaction of multiple narratives. And so I think that the mindset that people have today is a bit fragile. And the election coming up is in the works. It's creating a sense of dread, which there's something that psychologists call the affect heuristic, that when you're worried about one thing, you tend to be worried about other things as well, if they don't drive your attention away.
So just so you know what that means, that's a phrase, the heuristics are a way of thinking, a way of reacting to something. So for example, if I say gunshot, you might think, ooh, bad. Or if I say lottery, you might think, ooh, good. Those are heuristics, right? And we use those to simplify our investing decisions. So for example, for many of us, if I say Tesla, we think, yay, good, I love Tesla. I want to own more Tesla. But unfortunately, that can sometimes overweight our passion, like our passion for the company can overweight our investing decision, and we go in too heavy at unreasonable prices, right? That's what he's referring to here, that, hey, you have to be careful of that, but trying to find this balance between our emotions and what's actually happening is hard. We don't have the answer, but his bottom lines so far are stay in the market, don't get out, and number two, just be prepared for that volatility. So psychologically, be prepared for that roller coaster, and be prepared for, maybe some buying opportunities, in my opinion.
And if there's another shock downwards, I think there could be a reaction among other investors, and I'm pointing out it as a possibility, not at all a certainty. But the stark reality is that people are fearful that this is 1929 again. I'm not making that up. It comes from my surveys, and they think the market is highly priced. This is a bad combination. It could be a bad combination, and I don't know the certainty what the future will bring. I think people should be aware of that and not over-focused or overexposing them to say information technology risks.
Yeah.
In other words, don't go too crazy and leverage up every possible penny you've got to go crazy all in on tech right now. After this part, Robert Shiller goes into this much more complicated discussion, and I just kind of want to boil down the nuts and bolts of what he said. It took like 6 minutes to say what could be said very shortly. Basically, he talks about these fancy curves and how when interest rates go down, yields on bonds go down, and it's understandable for stock prices to go up because of that. And if we extrapolate further from this, we can say, okay, well, when do we think interest rates are going to go up? Well, every indication we have says not until 2023, 2024, and unless we get some crazy inflation coming up before then, which we're unlikely to, with the exception of maybe March and April when we look at year-over-year figures. With the exception of that period of time, we're not actually expecting inflation. We might actually instead have low interest rates until 2026. I think that's why Robert Shiller, this famed economist, is basically saying, look, yeah, there are definitely some yellow flags in the market right now that make for good doom and gloom videos, but none of them right now are 100% saying, get out. And if anything, they could potentially be contrarian indicators, and now we might be able to look back in 5 years from now and say, should have bought some of those dips when fear was higher. So now, how do we back away from all of this, all this talk? What's my strategy? What are we doing here? My overall strategy has been pretty consistent, sticking to my favorite 41, 42 stocks. You can see those at metkevin.com/1337V13. And essentially, when we get some sweet red days like we did on Monday, Wednesday, and Friday of last week, add to them. Don't go too heavy on margin. Keep that under 10% if you're using it at all, because, hey, we could see some bigger sale opportunities. And if the market does sell off after the election, well then, hey, there's still some money available. So there's some insight on the latest from Robert Schiller. Really appreciate this guy's insights. And interesting that he's actually still bullish enough to say, hey, stay in the market, just be prepared for a potential roller coaster. Let me know what you think in the comments down below. Get your 3 free stocks with Webull, get your life insurance, and folks, we'll see you next time.